Should you pay off your mortgage early? Yes, of course. As an accountant and finance professional, I always get asked questions around the subject of mortgages, especially questions around overpayments and completely paying off the mortgage early. Let me explain the narrative around overpayments on a mortgage, and why paying off a mortgage early is almost always a good, solid financial decision. The term mortgage dates back to the late 14th century, with the root word mort meaning death in French and gage meaning pledge. While that literally makes a mortgage a death pledge, it's not as eerie as it sounds. You might assume that the death in death pledge relates to either the painful process consumers must endure on the road to home ownership, or maybe you associate signing mortgage papers with signing your life away. Although mortgages get such a bad rap, it's not uncommon why people think they can't get rid of the mortgage pledge early. To most, it seems impossible. But I can assure you that it is completely doable with only some extra effort. According to Forbes Advisor and their mortgage partner better.co.uk, the average cost of a 2-year fixed rate mortgage across all borrower types in February 2024 stands at 4.85%, i.e. mortgage rates are high. So it's not surprising that homeowners look to overpay on their mortgage loans to offset the impact of today's more expensive interest rates. In essence, if you have the cash, overpaying a mortgage is a no-brainer. Let me explain. Firstly, any overpayments you throw at the mortgage debt are completely free of any interest. You are reducing down the initial mortgage loan and saving money on the interest, as you do not pay interest on any overpayments. So if your monthly mortgage repayment was £750 and you doubled it by overpaying another £750 on top, you would only be paying interest on the first £750. The second £750 would be interest free, meaning you're paying back that part of the loan without any interest, i.e. borrowing free money from the bank. Furthermore, the overpayment amount would be just as strong eating into your debt as much as the initial mortgage payment. Secondly, by making overpayments, you'll be eating into the debt you've built up from buying a house, i.e. the capital, meaning you can be mortgage free much sooner. It's important to make sure any overpayments reduce the debt and shorten the term, rather than reduce your monthly payments. When making overpayments, the bank may ask you to reduce your monthly payments, but say no. The expression time is money has never been so important in this scenario. The longer you borrow money, the more you pay back in interest. So ask to pay this directly to reduce the debt and shorten the term. On your screen, you can see an example of how overpayments work. This example is of a mortgage that has a 25-year term, and the mortgage is for £150,000 at 5%. So as you can see, overpaying just £10 per month will reduce your mortgage term time by 6 months, saving you £2,890 of interest. If you overpaid £100, you would be mortgage free 4 years and 6 months sooner. In the run, you would also save £23,200 in interest. If you overpay your mortgage by £1,000 per month, you could essentially be reducing your mortgage term in half, i.e. paying off the mortgage 16 years and 10 months sooner. And in the run, you would be saving £80,340. So that is the power of overpayments and why you should take the opportunity to do so. The above example leads to the mortgage being paid off substantially quicker and saving you a ton of money in the process, which would have just gone to your bank anyways. But what are the benefits of this, you may ask? Well, an upside is the increased cash flow paying off your mortgage has on your life. The typical millionaire pays off their house early and never borrows money again. Your income is the biggest and most powerful wealth building tool you have in your arsenal. So by paying off the house, the money which was being budgeted for the mortgage payment is now increased cash flow and can be used towards increasing your savings pot, investments or retirement, or used towards general wealth building. When making overpayments, you gave up buying a new car, eating out all the time and holidays to do it. But once you pay that mortgage off, you have an increased cash flow to have even newer cars, eat out more often, have amazing holidays and have a secure retirement and nest egg, especially a nest egg including a solid paid off property asset. Also, and this is a big one, the peace of mind it brings. Just knowing your bank has nothing to do with your property and that they are no longer in the loop. Furthermore, the Bank of England, which sets the base rate, can't also affect your finances. Even if you have a fixed rate, and it's a good fixed rate, eventually this deal will come to an end, so any increase in the base rate won't affect you either. Having a paid for house is a solid foundation to fall back on in the future. It may be the best investment you make in terms of emotional health and financial stability. Just like hitting the subscribe button. And again, thanks for watching.